family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am now in Madrid, Spain, and I'm here with our guest host, Enrique Abeyta from HX Research. For those of you wondering about Rob Farian, he is probably 48 hours or so away from becoming a father. Last we heard, his wife and the baby are doing great. So hopefully when we do next week's version, we will be coming to you with great news. But in the meantime, we have the always capable, always interesting Enrique Abeyta in the guest hosting chair. Enrique, how was your weekend?
It was good. It was good. I actually took my kids. I've got a 12, 8, and 4, and took them to Salem, Massachusetts, where we were trying to beat the October rush with only fair success. So it was a long weekend.
So it really interesting you mentioned that, because I was walking around Madrid this morning and they have ads for Halloween costumes up here.
Okay.
And I thought that was an American holiday, but they apparently are getting ready to celebrate Halloween here.
It's huge in Japan, by the way. But actually dressing up for Halloween is a very big European thing as well. It's done a little bit differently, but there's a lot of festivals, like, not necessarily just for Halloween, but like where people dress up. It's a big thing. So I don't know if you know this. You were just telling me that you're in Madrid. I actually lived in Spain when I was a kid. I lived in a place called Playa de Castelldefels, south of Barcelona, for about the better part of a year in 1978. So a long time
ago. that is interesting. And I noticed the pronunciation. What's that called when they change the Z or the S to the sound?
Well, I don't do that. I actually don't do that. But in Catalan, I'll leave you with this one last story. Is I went back 25 years later, and one of my cousins had married a Catalonian man who was very nice, but they speak like this. They speak with a lisp. And it's part of the Catalan accent. And I had a difficult time talking to him. He was a serious guy, but like listening to the lisp was a little challenging, but it's their culture and their language. So no real criticism.
No, I understand. It's hard to take someone seriously when they're, it just sounds like something out of, something else. Anyway.
Yeah.
Yeah. So, and in Salem, do you want to go on record here? What's your position on witch burning?
I mean, we haven't done one in a while, so I suppose if we had real witches, I'd have a position. But I will share this one last completely useless anecdote. All October long, I put on the weekends, I put Halloween movies on, and I've actually seen Hocus Pocus 2 about 100 times, and that's not with my daughters. So like, there's the weirdest thing you're gonna have a guest ever say.
All right. Well, I'm a fan of the old Bugs Bunny cartoon, the one where he's in that castle with the vampire, and he keeps saying Hocus Pocus and Abracadabra. And whatever, we'll have to look that up and get screenshots.
So let's talk about. So let's kick off this week with some Hocus Pocus, huh?
Yeah.
Right, well, the first topic. Like, I don't know if you want to dive in, if you want to take the introduction or me, but
no, go ahead.
I think the first topic that I've been writing about a ton over the last few weeks has to do with some potential Hocus Pocus. Nvidia last week announcing this deal to invest up to $100 billion. Here's the air quotes into OpenAI to build the OpenAI infrastructure. This is on back of the OpenAI $300 billion contract with Oracle. That was signed a few weeks later. And, look, I got a lot of thoughts. I'll let you start, though. Let's talk a little bit about what you've been saying about these topics. And I guess the overarching topic is we now have seen some very large investments in AI from a group of companies that are part of this Stargate development that are not part of the traditional cash flowing hyperscalers. And the scale and scope of these numbers are causing some questions, given the lack of cash flow, revenue, profitability at OpenAI in particular. So,
right. All right. So for the, we did talk about OpenAI last week in relation to the Oracle deal. But now let's talk about this Nvidia deal. Let's give people a little background in it. And I'm going to highlight some of your recent comments on the subject and some thoughts I've had on it as well. So what was announced last week was the headlines. They were technically correct, but very misleading, that Nvidia and OpenAI signed a letter of intent to deploy 10 gigawatts of NVIDIA systems to power OpenAI's next generation of AI infrastructure. Now, the headline said NVIDIA is partnering with AI and they're investing $100 billion into OpenAI. And when I first read the headline, I thought, oh, wow. So NVIDIA is going to write a check and OpenAI will have $100 billion. That's a lot of money. It's a lot of cash, but that's not really what happened. So what's going to happen here is NVIDIA is going to build out the system. And so, to the extent that they're giving OpenAI the money, OpenAI is using that money to buy NVIDIA's best chips, right? It'll be the Vera Rubin architecture next year. So basically, another way to look at this is NVIDIA is partnering with OpenAI and buying $100 billion of chips from itself, right? And these are the kind of really interesting accounting shenanigans we saw about 25 years ago, right? Where basically it's a financing deal, and NVIDIA is giving OpenAI the money, but OpenAI is using that money to buy NVIDIA chips. And so somebody might say, well, wait, why are they doing it that way? And the reason is because NVIDIA can count that as revenue, and trading at somewhere in the neighborhood of 40 times free cash flow. NVIDIA needs a lot of revenue growth to keep the stock valuation where it is. Now, let's go to some of the commentary on this, which I think is really interesting. One, and we'll get to you in a minute on this, Enrique. Last week, we were quoting you, talking about your comparison, saying OpenAI looks to you a lot like Enron did 25 years ago. And one of the things you cited were these gigantic long-term contracts. And like, wow, Enrique wrote that a week ago. And then, just a couple of days later, we get the deal with NVIDIA, $100 billion. That's a big headline number. So I think you are very prescient on that. The other thing is I revised my opinion on this. Last year, people asked me, hey, don't you think NVIDIA looks a lot like Cisco from 25 years ago, right? They're both selling the architecture, right? Only Cisco was selling all of the servers that the .com companies were using, and NVIDIA, they're selling the chips that everybody's AI is based on. And, I said, I see the comparison, but I don't agree. And the reason I didn't agree was Cisco was selling servers to pets.com and other companies that, their business plan was to sell dollar bills for 90 cents, make it up on volume, and try to monetize, the eyeballs that they had access to. NVIDIA, on the other hand, their big customers were gigantic hyperscalers that had unlimited free cash flow companies like Google or Alphabet, Facebook or Meta, Amazon, right? And so, you look at that and you say, wait a minute, NVIDIA's customers actually do have money. They have business. They have businesses. This is real. And I said, it's not the same. Well, now we're in the financing yourself and paying somebody else to give you revenue part of the show. And we might need to revise that opinion. And so, the comparison, and Enrique, I'm going to ask you about this. You're comparing OpenAI to Enron from 25 years ago. Do you still think that, and why? And should we now be comparing NVIDIA to Cisco from 25 years ago?
So, look, there's actually a lot more nuance. Enron had a real business, okay? WorldCom had a real business. Those would be two companies that I would highlight that were focused on bandwidth, energy, kind of like all the things that were happening and that were hot at the time. so it wasn't that they were fraudulent per se. They ended up actually having some fraud in the numbers, but they were capitalizing on very real things. And as you went through the course of the cycle, what happened was the later stages of having to keep that growth going, or the perception of growth, reached a stage where we really were just overcapacitized. And so what happened with the telecom cycle, we had all of these fiber builders, the CLECs, the cable companies. I was a big investor in Flag Telecom, which was building a cable across the ocean. And what's interesting to me about all of that, none of these companies did anything wrong. Enron and WorldCom did, actually. But like, my point is, as an ecosystem, none of the companies did anything wrong. And when you look at what was happening at the time, when Cisco and Corning, which was the maker of the fiberglass, they would get up and they would say these incredible numbers, I think the companies believed them. And when I look at what, let's look at each of the players here. Like OpenAI, I think is doing the rational thing by trying to raise as much money as they can and build as much as they can as quickly as they can, because it's really one of these, like, get going while the going is good. And so I don't fault Sam Altman for putting these ridiculous things out there. And I think his goal is to try to get as much money in the coffers as he can. And he does fundamentally believe that it's all going to play out, as do I. It's just a matter of timing. And so I believe Jensen too. But one of the things that really gets me is I hear like this story. So, dude, railroads, okay, radio, electrification, television, the internet, mobile phones. We've seen this cycle over and over and over. And what I'm loving on the TV right now is I'll get, and I actually like Jim Cramer, but Cramer will be like, but you know what? Jensen sees everything, so Jensen knows more. Okay. No, Jensen's on the same wave. And what is Jensen supposed to say? What is Jensen supposed to do? Is he supposed to say, hey, no, Sam, I don't want you to buy $100 billion worth of chips? Like, how's that supposed to work? That he's supposed to go, hey, guys, you know what? I think we might be making way too much capacity and way too much chips. We're not going to sell anything more to you. Well, that's never going to happen. So when you get into this part of the cycle, no one's actually doing anything wrong, in my opinion, in this cycle. We'll see about Sam Altman eventually. That one kind of sketches me out a little bit. But I think they're all acting rationally, but acting rationally doesn't mean it ends well. And, even when we talk about what I'm fascinated by now is the relationship of the traditional hyperscalers, Meta, Amazon, Microsoft, etc., because they do have cash flow. But you know what they can do? They can stop spending and let their cash flow explode and still be in the best position because they don't have to raise any money to go out and do all this stuff. So, look, I was thinking of analogies here, and the best analogy, I'll share a couple of them real quick. I love surfing analogies. I love water analogies. This is like, we know there's a hurricane coming in and we're out on Long Island, but until the hurricane hits, dude, the waves are going to be awesome. The best waves you'll see all year. And depending on the size of the hurricane, the best waves you'll see all decade. The key, though, is when you go out and surf those waves, you may get some of the best waves you may see in the next 10, 15 years. But when that hurricane actually gets there, you're going to get killed if you're on those waves. And that's kind of how to approach this. So when I published a piece in a publication I have called Truth and Trends. You guys can just go to truthandtrends.com last week. And I gave a whole bunch of data why I'm very bullish, believe it or not. But then I ended with the 98 example. Okay. I started my career as a money manager in 1996, was managing $250 million by 97. And 98 was the long-term capital debacle. I won't go too much into it. Big leveraged hedge fund exploded. People were concerned that it was going to bring down the entire capital markets. And at the time, the Fed cut 75 basis points in short order with the market near its highs. Now, it had come off because of LTCM. But what that set off is it was basically the spark in that late stage. We were already 2-3 years into the internet spend, which, by the way, I'm going to argue we are here now, because remember 2023, 2 years ago is when we really set off the AI spend. So it's not 6 months anymore. It's 2 years. And so what happened in 99, S&P was up 24%. The NASDAQ was up 85%. I mean, people ask me the craziest things I've ever seen in my career. I was at my desk for September 11th. I saw the flash crash. I saw global financial crisis. I traded through COVID. That melt up in 99 was the craziest thing I've ever seen by far. So bringing this all together, do I think these people are doing something bad, fraudulent, etc.? No. Do I think this is going to end badly with stock prices for many of these companies, Nvidia, so these direct companies, much lower for a period of time? Absolutely, yes. Do I think that OpenAI even exists in 3 years? I doubt it. Okay. I think it gets sold for $50 billion. But there's this weird juxtaposition that right now we've got the best waves we might have for the next decade. So we're actually helping people surf those waves, but we're getting ready for that hurricane to roll through. So it's sometimes as a trader and an investor, you have to exist in two places at once in your brain. I use the example of blackjack. You know, if you're a cold killer blackjack player, which I happen to think I am, I'm pretty good at it. You know, you actually have a slight disadvantage against the dealer. You're going to walk to that table, you're going to lose slight majority of the time. Yet you go up to the table and you know you can win with good money management by playing perfect blackjack and knowing when to walk away from the table. And that's where it's like, I know I'm going to lose, but I know how to win. And that's where I think we are in the markets. But yes, this will end very, very, very badly. One last thing, I just want to go off on one company, Oracle, man. Like I don't know if people realize Oracle's levered like 4 times net debt to EBITDA, 500% debt to equity. This company has 110 billion of debt. So when we talk about Microsoft, awesomest balance sheet ever, Meta, awesomest balance sheet ever, Amazon, awesome balance sheet ever, and we put Oracle in this group, Oracle right now trades at a higher multiple than Nvidia. And Oracle has been missing numbers. They missed that quarter. They missed it by 1%. And all they did is said, hey, you know, this backlog that's being financed, I don't know how, you know, went up 4-fold. But yeah, we actually missed our numbers right now. So like one company to focus on. I'm full disclosure, I'm long February and March 260 puts in Oracle. And I absolutely love that trade even now, even though I've doubled my money in the last week. So yeah, I think this is, and I will give one last thing, which is, I think I just posted this on Twitter. Professor Scott Galloway has this guy, I think his name is Ed Olson, works with him. He posted this stat that in 1870s, 20% of US capital investment was going to railroads. Right now, it's just about 2% to AI. But in the 1870s, less than 0.1% of Americans owned stock. Today, that number's 62%. And by the way, about 40% of that is AI related. So when this bubble pops, this will be what causes the recession when data center spending comes down, and it's going to hit the stock market. So again, let's catch these tasty waves, but like, be ready, be prepared.
All right. So double points for quoting Jeff Spicoli. I caught that one. And I think, you know, it's a really, really astute analysis, Enrique. The one thing that I'm going to add to that, I don't know if you read Stephen Innes. He writes a great Substack called Dark Side of the Boom.
Okay.
He writes a lot on macro, on currencies, currency trading. But he pointed out last week that 9 of the 10 largest US companies are AI proxies. The 5 largest make up 20% of global market cap. And now I'm going to point out that if you're right, that, you know, there's an issue at Nvidia and Oracle, you know, Microsoft and Google might have great balance sheets, but once these stocks start to crack, they're all going down. And the entire market is very, very, very leveraged to a very small number of companies, all with the same investment thesis. And so once those multiples start to collapse or implode, everything is going down, right? It's not just going to be Oracle, Nvidia, and whatever private market valuation there is for OpenAI, right? That the whole sector is coming down.
And this gets to your point, which we're going to do the second point here in a second. But we've seen this play before. We saw this in 2000, and so but I can't emphasize enough that while I'm long those Oracle puts, I'm not short this market. We're much more long than anything else. But yes, when this breaks, Microsoft will go down a lot, 20%, 30%. There will be no place to hide per se. Not even gold, by the way. Gold is a risk asset. I want people to understand that gold only goes up when risk assets are hot. It outperforms in down markets because it doesn't go down as much, or it doesn't go down. But the second point that you brought up this week was about manufacturing growth. But let me end with one point about AI. The data is very credible that if we did not have the data center investment that we have right now, and I'm going to add on to that the impact of a buoyant stock market, we would be in negative GDP growth at this moment, and we might be in negative jobs growth. So this is what I'm saying is when we finally tip the scale, that the big hyperscalers go, you know what, we got enough for the next month, for the next year or whatever it is. And that just takes a step back. We will go into a recession. Now, looking 3 years out, I posted this on Twitter the other day. The good news is the Federal Reserve has 400 basis points worth of cuts in front of them, which I think they'll do in 2027 and all that. But we got a long ways to go from there. But let's talk about this. You pointed out that manufacturing growth is continued, but it's at a slower rate. Why don't you dive into that with your thoughts? What's going on there?
Yeah, so what we're talking about here is the PMI, that stands for Purchasing Managers Index. For people who don't follow economic news on a daily basis, it's just a monthly indicator derived from surveys of supply chain managers across multiple industries, and it gives us a sense of how much manufacturing activity there is in the United States. Values above 50 indicate expansion, meaning it's growing. Values below 50 indicate contraction, meaning negative growth or slowing. So what we had last week was the flash PMI, which is the preliminary estimate. And we all know how accurate the government's preliminary estimates are, but it slid slightly to 52 from 53. So, the headlines were, oh no, the PMI is sliding, it's going down. And, my response to that is, no, we're just getting slightly slower growth than we had before. But, that doesn't sell newspapers or clicks. The other news on this that I thought was kind of interesting was new orders increased a little bit. Production gains existed. They were just a little smaller than August. And some of the surveys in the index indicated a buildup of unsold inventories because sales softened a little bit, but again, still growing. What I wonder about, and I don't know this for sure, is I wonder if some of that is related to tariff fears, which were companies temporarily over-ordered. They were worried about it. On the issue of tariff fears, I'm going to point out that last April, the fiat economists were hysterical, saying, oh no, we're going to have a depression because of this. We're going to have a global recession. We're going to have empty shelves because all manufacturing is going to stop. Guess what? Not only do we not have empty shelves, we have a buildup of inventory. It's the exact opposite. I've yet to see one of these fiat economists say, okay, yeah, we apologize, we got it wrong. They're still insisting they're right, which, good luck with that. The only other thing that I would add to this, actually two things. One, this data was produced before last week's Fed rate cut. It'll take a few months for that to work its way through the system. So it'd be interesting to see if the Fed's rate cut leads to an increase in manufacturing. And then, I was pointing out on Twitter or X this morning that, 2 weeks ago, everybody was saying, oh no, government data is inaccurate. We can't use it. The revisions are gigantic. It's useless. And somehow this week we're all at, oh no, if we have a government shutdown, we won't get the data. Okay, guys, which is it, right? Is the data inaccurate and useless, or you desperately need it to invest? And my view is we do not need inaccurate government data. We'll all be fine. you know, like Enrique, you were talking about all of the various events that you've lived through and traded through and managed money through. How many government shutdowns caused a real problem?
Yeah, look, the media exists to get you to click on something new. And the concept that we're just in a bull market, money supply is growing, GDP growth is good, the market's going to grind higher, is not particularly clickable, versus any given piece of government data that drops at any given point is. And so we put very little into any short-term government data. You know, I think so. I think that's just a general rule. If it causes dislocations, you probably want to fade that dislocation. You know, take the other side. But we kind of ignore it. And you know what John Griffin, the manager of Blue Ridge, which is one of the most famous Tiger Cubs, perhaps the most successful Tiger Cub of all time. Tiger Global was a Grand Cub. It was Chase at Tiger. I forget. Anyway, I would still say Blue Ridge was more successful. You know, he once told me, he goes, you know, look, if you're that concerned about with your portfolio, if you're that concerned about a single macroeconomic report, you shouldn't be concerned about the macroeconomic report. You should be concerned about your portfolio construction. And so, you know, that was an eye-opening moment for me 30 years ago. But it does bring up a subject, which is what is happening in manufacturing growth. And, you know, look, I think there's a lot of cross currents, and overall, I believe, you know, I think we're looming on a recession. Again, is that I think that once the data center investing peaks, and it will peak, everything peaks. Every capital cycle in the history of humanity has peaked. I don't care what Jensen Huang says. Every one of them, once it peaks, we will likely go into recession. But that being said, you know, there's plenty of positives, and I think they're kind of non-issues right now. So I think it's interesting to watch. But you know, the AI situation is 10 times whatever's going to happen with core manufacturing at this point. So going to something also something that may not peak, by the way, you know, your next point, you were, and this number blew me away. I didn't realize this.
Yeah.
I really kind of, I don't doubt you, but like you wrote that BlackRock is making $250 million. Oh, it's $250 million a year in crypto and Bitcoin ETF fees. So they're making 250 million of fees on those. Okay.
Yeah.
What's the AU?
260.
Okay.
So the AUM, hang on, let me check the chart. And we're going to credit DKI intern Cash and Crow, who always puts together the charts. He does a great job with these. The assets under management for their Bitcoin ETF, that's IBIT, is a little over $80 billion. And their ETHA is more like 16 billion. And BlackRock is making their fees on the Bitcoin ETF $218 million a year. The ETH won $42 million a year. And it's particularly profitable for them because their fee schedule is, you know, what's written here is 25 basis points. I thought it was slightly lower. I thought it was more like 19 basis points. That's from memory, so maybe I'm wrong. But the point of all this is that for BlackRock is a giant fee for an ETF. So they're looking at this saying, wow, this is incredibly profitable. I would point out to me, there's a big winner and a big loser from this. The big winner are the owners of Bitcoin and ETH and other, you know, non-zero-ish crypto, where, you know, it's worth pointing out that the ETFs were approved by the SEC only 18 months ago. It was April of 2024.
It's the fastest ETF growth in history, by the way. I bet. Yeah. Just so you know, like it's not even close.
Yeah, these things have grown by an enormous amount, and they've enabled people to have Bitcoin exposure in traditional asset management, in their brokerage accounts. It's also making it easier and possible for people to have Bitcoin exposure in their pension funds, which, you know, that's trillions of dollars. You know, part of my thesis, Bitcoin is my largest position Part of my thesis is increased institutional adoption. But, just from a regulatory point of view, look at where we are today versus where we were 18 months ago. You got the approval of the ETFs, you got the Genius Act, you have, the ability, again, for retail, for financial advisors, for pension funds to all get their clients exposure. I just think from a regulatory point of view, we are night and day from where we were just a year ago. And the fact that the BlackRock alone is managing $100 billion of assets in just these two funds, that's incredible. That tells you where they are on this. Now, the big loser, I think, is the Grayscale Bitcoin Trust, GBTC, where they had the market to themselves for years and years, and they could have had BlackRock's fee schedule on this. Instead, what they did was Grayscale decided to maintain a very high fee schedule, I think more than 2%. So more than 8x what people are paying to have the exact same exposure at BlackRock. And so, their assets under management are less than 1/4 that at BlackRock alone. Now, people who are, sharp pencil or at least back of the envelope guys can say, well, wait a minute. You're talking about more than 8 times the fee schedule, but 1/4 of the assets under management. Does that mean they're making more money from this? And the answer is yes, but it's not a good long-term plan, right? Long-term overcharging people and having them trapped for tax reasons, that is a runoff business. And, they should have considered maybe being a little bit above the market, but not so far above the market.
So we actually wrote in HX Weekly last week about Bitcoin, but I got another loser. Let's just start with losers. Strategy, MSTR, trades at still. This is what when I'm looking away. By the way, everyone, it's like I'm not checking my email, and there's no sports scores to check right now. So I'm looking at different data that I'm investigating on my Bloomberg here. Strategy still trades at a 42% premium to NAV. And I'm just pulling this off of, a website. I don't know if that NAV, how much they're taking into account the enterprise value, the value of the debt, but Strategy, MSTR, MicroStrategy, as it used to be called, has actually dramatically underperformed Bitcoin in the last year or last 18 months. And the reason is, I bet, plain and simple, is that all of a sudden people have an easy way to buy Bitcoin. So let's take one side. I think Strategy is highly problematic. I think that 40% burns off. History would tell us, by the way, the Grayscale Bitcoin Trust, I just checked, actually trades at a discount to the Bitcoin that they own. It trades at a 5% discount. So I'm going to argue that Strategy eventually is going to trade not at a premium, but at a discount. So the trade that I love is going long Bitcoin, perhaps even leverage long Bitcoin against Strategy. And let's just talk about Bitcoin here. Bitcoin is digital gold. It truly is. Seasonally, last year, it kind of was sort of punk going into October, and then it flew into year end. Now, partially, we could say that was because of the Trump administration. But remember, when the Trump administration was voted in, we did not know how positive they were going to be on crypto. And by the way, Bitcoin did the exact same thing last year. So, we have had a thesis out there. I think Bitcoin goes to 1 million. I think we see a stair-step function seasonally here with Bitcoin. And let me go back to what I was saying before about AI is, look, I think we've got a very good chance of seeing a melt up in the NASDAQ. If the NASDAQ's up 50%, what do you think Bitcoin's going to do, in that period? Is it going to be down? Will be up 50% or will be up more than 50%. So I actually, and I don't, even though I come from a hedge fund background, I don't really talk about pair trades very much, but I kind of really love go leverage long Bitcoin against short Strategy. And, it's like you got a 42%, premium to burn off. Like, I think you could actually see, your Bitcoin go up 40% and your Strategy go down 10%, So, but yeah, we're very bullish on it, and I think that we've just got it's 80 billion today. You know what I don't know? Hold on one second. I'm going to look this up. Total amount of money.
By the way, while you're looking that up, do you know what I find to be the most perplexing thing in the market today? All of these crypto treasury companies that traded a multiple of NAV. And when I talk to people like, what, why are you paying for this? They're like, yeah, but you get exposure to the thing. I said, but you could go on Coinbase and go buy it directly.
It's just the normal, kind of mild insanity we see at this stage of the cycle. What I was looking up, by the way, there are $386 billion in gold ETF assets under management. So when we talk about IBIT at 80 billion or things like that, this is where the upside is. Okay, so the next subject, which is going to be a controversial one here, okay, because you and I actually think the polar opposites on this one, believe it or not.
All right.
Fed, Jerome Powell last week basically said, or 2 weeks ago, said kind of no matter what I do, there's going to be risks. And, and you have the belief, I'm reading what you said here, that the Fed doesn't know what it's doing, and you would potentially like to see the end of the Fed. I'm going to just let you expound upon that, and then I'll share my quite contrarian view, because I think your view is sort of consensus. I don't mean that as an insult, but I think I hear much more of that than what I'm about to say.
Yeah. So, and you may be right on this, and I don't mind you saying I have a consensus view. It's really interesting. A lot of times people say, "Oh, Gary, you're a contrarian," and I say, "No, I'm not. I'm just somebody who looks for the truth, right? A path of truth." And one of the things I point out is most of the time, everybody isn't stupid and wrong. You look for the individual situations where the consensus view is stupid and wrong, and that's your opportunity to make money. But most stocks are fairly valued. Most consensus understandings of the economy are going to be correct. Most people aren't dumb and wrong all the time. It's those situations and they're not trying.
And the funny thing is, we forget. Like I always get a kick out of, like, there'll be someone who says, "Oh, this person's an idiot," blah blah blah. I'm like, they went to the same school as you and have the same degrees, and they're working just as hard as you. Like, they're not genetically stupid, but they have a lot more information than you, and they're you, by the way. So did you ever wonder if you were in their seat? Maybe you'd have. It's just this, like, it's very easy. It's like watching football and be like, "Oh, I would have totally thrown it to the guy, the guy out on the left flank. If I was playing quarterback." Yeah, well, you know what? You also didn't have a 385-pound defensive tackle about to pancake you. So, but anyways, go ahead.
And no, it's interesting. A couple of weeks ago, I put out this really long 30-page macro update, and I hadn't written anything lengthy in macro for a year. And somebody said to me, why are you doing this now? And I said, because now I disagree with conventional wisdom. For the last year, I've thought people largely had it right. And, I wrote so many times, people think the Fed is going to do X, Y, and Z. And I'm like, yeah, I agree with consensus. I think that's what's going to happen. And it's not my job to disagree with everyone all the time. It's my job to figure out what's going to happen. And sometimes I'll agree with everyone and sometimes I won't. So I'm not the least bit insulted that, you think I've got a consensus view on this. At any rate, last week, Fed Chair Jerome Powell was speaking in Rhode Island, and his message, which I agree with, is that there's no risk-free path for the U.S. economy in the near future. Powell thinks any decision he makes will have a downside in another area. I agree with that as well. What we have is inflation that is uncomfortably high and a balanced job market, but it's cooling. But people are very focused on the fact that we've had a decrease in the number of people who are newly employed. Okay, fair enough, but that means the employment situation, the number of people with jobs is growing. And the other thing is, normally that would lead to lower wages, but it hasn't in this situation. And the reason for that is we've had repatriations, right? So for all the people who said, hey, if we send people home, you're going to have problems in the job market. No, we actually have a balanced job market right now. But in the meantime, by admitting that no policy choice is without hazard, Powell's describing the Fed's lack of confidence in its chosen path. For 2 meetings ago, he flat out said in front of, in his press conference, he said, yeah, we don't have a lot of confidence in our projections. And I agree with him. They don't, and they shouldn't. Here's where we are right now. We've got inflation that's too high. And so typically when you have inflation that's too high, the Federal Reserve in response to that would raise the Fed funds rate. The problem and the reason Powell doesn't want to do this is because if they raise the Fed funds rate, it's going to cool the labor market more. And they're worried that with a smaller and smaller number of people getting new jobs every month, that they'll unbalance the labor market. And they're more worried about a recession than they're worried about inflation. In my opinion, President Trump has been right in his criticism of Powell, although I disagree with the president on the correct course of action. He said Powell he's called him, I think, too late, Jerome Powell. He's right. The Fed was far too late to raise the Fed funds rate when inflation was an obvious problem. Better yet, with all the PhD level economists they had in the building, how come nobody could figure out that Congress spraying trillions of dollars of free money into the economy would lead to inflation? He was late. I disagree with President Trump that the right response here is to lower the Fed funds rate. I think it's just going to lead to more inflation. And what the president wants is he wants lowered borrowing costs to juice the economy. And in fairness, every president wants that, whether you're team red or team blue. Your president wants a low Fed funds rate and a hot economy. That's what they all want. My issue with President Trump's approach here is not that I think what he wants is wrong. It's that I think his preferred economic policy of a lower Fed funds rate doesn't lead there. I think you have a lower overnight rate. At that point, the bond market prices in higher long-term inflation, and the yield on the 10-year, which is how your mortgage rate gets priced, which is, you'll have your credit card bills priced off of this stuff. It ends up going up. That's what we had in September of 2024. So I think that's what we see there. My solution to this, which Enrique, you are more than welcome to disagree with, is to end the Fed. I think the Federal Reserve has existed solely to steal from the American people slowly, to allow for inflation, a ridiculous expansion of the money supply, and your money is being stolen from you slowly, and people just don't notice. We've all been conditioned to view inflation as the normal course of events. This is sort of what we all expect, and people say you need inflation to have economic growth. That is 100% weapons grade baloney. Stable prices lead to growth. Inflation leads to spending, right? It doesn't lead to saving and investment. So my solution on this is end the Fed, let the bond market set interest rates, and let the market figure out that we really should have stable prices, not an inflation rate of 2% or 3 or 4%, or which, by the way, the Fed has now made it clear they're going to be targeting 3 or 4%. And, I think the CPI has been understated for years. So, listen, we can agree, we can disagree, but if you're looking at more inflation, whether you like it or not, you can invest in ways to make money from that. And that's what we've done. But Enrique, what's your view on it?
Well, it's a very deep subject. So I'm going to keep my answers pithy in the interest of time, and not trying to be dismissive, because we could spend an hour on this topic. I'm going to start with a quote from Winston Churchill. Many forms of government have been tried and will be tried in the world of sin and woe. No one pretends that democracy is perfect or all wise. Indeed, it has been said that democracy is the worst form of government, except for all those other forms that have been tried from time to time. And great quote. I like getting the direct quotes. And I think this applies to the Fed. Without the Fed. So I'll just go to two things. Without the Fed, when we're facing things like the global financial crisis, we would have gone into a depression. There's no doubt about it. They screwed up the first part because it's hard in the beginning when you're scrambling, but they got the second part, and we've avoided a depression. We have been in a period of the most consistent real economic growth across 30, 40 years that has ever been seen on the face of the planet, and it's continuing. You can see it in the numbers, like it's still growing. Like we might go a little bit this way or that way. And so I sort of say, well, if not the Fed, then what? Because number one, it puts us in big risks of massive collapses in those situations. Number two, you blame the Fed for the inflation. I don't really, look, you said they're quietly stealing people's money. Get rid of the Fed, and it's going to go from quiet to in your face. So, like the inflation and devaluation is like the tides and the currents and the waves. You just have to accept it. Every currency in the history of humanity has been devalued and devalued consistently. It's a law of physics. So
they all go to zero.
I turn this on its head. Is instead of me trying to fight the fact that the sun is going to come up and the sun is going to set, that the tides are going to come in and the tides are going to go away, why don't I figure how to take advantage of it, how to harness that power as opposed to doing it? So I hear you, but I just don't like, to let the bond markets by themselves. We would have been in my lifetime. We would have been in at least two depressions, not cool shit, like bad, like millions of people, Dust Bowl kind of crap. So is the Fed perfect? No, but they also have a hard job, man. Like this is not like, it's one of the most complicated jobs in the world. So can it get better? Can it be improved? But ditching the Fed, I think is a recipe for disaster. But this is a very big topic. So I'm going to stick with my Winston Churchill quote as my core philosophy on what we're talking about here.
So let me tell you where I agree with you. First of all, I like the Churchill comment, because just a week ago on the 5 things, we were talking about a policy where I said, I'm in favor of this. And someone said, isn't that against your typical economic beliefs? I said, yes, but this policy is better than what we had before. It's still bad, but it's less bad than what we had. And I'm going to be in favor of something that's less bad. And you're right, because we're not academics. We have to deal with the world as it is. And, you have to take anything that's improvement is a good thing. I also agree with you that the Fed doesn't create inflation. It's actually overspending out of Congress and expansion of the money supply that creates it. I also was being a little pithy and shortcutting it. Congress is the source in overspending, and that's a bipartisan problem, but the Fed enables it. And without the Fed, you wouldn't have that enabled. And you're correct that the Fed did take action that kept us out of a depression. However, I would argue that it was Fed-enabled free money that created the conditions that led to this. And without a Federal Reserve and free money, we might not have had the housing crisis and been in that position to begin with.
And I would argue it was Congress that actually created the preconditions for that and set it up by reducing the housing pieces, the housing regulations, et cetera. I actually look at it differently. I think the Fed is managing the crazies and doing their best job to contain them. And without them, we would plunge into chaos, because one thing that will never happen, spending's never going down, ever. I've been alive on this planet for 53 years, and it's not gone down once. I mean, we can argue a couple of years are in the clear. It's never going down, and it's going to accelerate. I'm telling you this right now. I'm 100% confident that government spending increases will accelerate from here, just like every economy and currency in the history of humanity. We're not different,
Yeah, that's another place where I agree with you.
Yeah, just we got to deal with it. Like it's like arguing against the tides. It's fruitless. So, but let's go to this last one. You do these educational topics, but I think this one's a really interesting one. I'm gonna let you talk about your take on it. But I have a really interesting take, because I've run quite a few small businesses. I mean, 5 to 20 million of revenue, and this topic is the one that is fundamentally the most misunderstood by small business people. Like I have on a regular basis dealt with people that are very smart, very intelligent, very successful, and and they have no idea, no understanding of this topic. Like it's not obvious to them. It's not something that's counterintuitive, but it just doesn't necessarily click when it's not again, it's just not obvious. So why don't we're talking about working capital here, folks. And my definition of working capital is the actual cash that is needed to run a business on a day-to-day basis. So you're going to see these accounting things of net income and EBITDA and all these other things, but the world actually operates in cash. I can't pay with depreciation. I can't pay with receivables. I one thing that works is cash. So in all of my small businesses, we only run cash books, by the way. And this is true of many businesses. I let the accountants deal with the tax books, which are essentially the accounting books that Wall Street would use, which, is a whole nother topic, but cash is king. But go ahead. I want to hear your take on working capital and the stock market.
Yeah. So just in the educational segment, I don't know that I so much have a take on it. I think we're just trying to explain it to people, but I would love to hear your stories on it. So for people who are looking at a balance sheet for the first time, the way you calculate working capital is just take your current assets, subtract your current liabilities, and that gives you the working capital, which is a decent measure of a company's short-term liquidity. Now, it does not get you the solution that Enrique is talking about, which is the important one if you're running a business. We'll get to that in a minute, but it's a good measure. And so what you want to do is get a sense of what kind of financial cushion a company has to cover their immediate expenses. And it's important to consider. So you need working capital to do things like pay your employers, pay your suppliers, pay your rent, right? And to get through any kind of slowdown in sales or an increase in costs or a seasonal slowdown, right? Some businesses are seasonal. If a company's working capital is low or negative, that can be an indicator that the business is in trouble, stretched too thin. If it's too large, right? And you think, well, wait, why would having, too much working capital be a bad thing? And the reason it can be a problem if it's too large is excessively high working capital can be an indication that a company is sitting on piles of cash or inventory. That inventory can go bad, it can go stale, it can become technologically obsolete. It's also an indication that a company doesn't have a place to put it to grow, right? It's too large working capital is in some ways an admission by a company that we don't have anything better to do with it. We don't have growth opportunities. The final thing that I'm going to add before turning it over to Enrique for his view on this is he's right that you want to be able to consider your ability to pay your bills. And so working capital doesn't always consider things like long-term assets or liabilities, or sometimes more importantly, credit lines. So you might have on the balance sheet zero working capital and think, well, wait a minute, how are you going to pay payroll this month? Maybe it's a seasonal business. And the answer might be, we have a credit line. We have access to cash. We just didn't draw it down and put it on the balance sheet because it was going to cost us something. So I don't know that there's one final answer on working capital, but as in, investors or new investors, we want you to understand it. The one final thing, sorry, I know I said final before, but that I would add to this is, my first job out of school, I was doing mergers and acquisitions at Morgan Stanley. And, we would be up all night writing these gigantic discounted cash flow models. Some of the models that I wrote actually took on the fastest computers we had like an hour and a half just to calc and print the summary pages, if that gives you a sense of the kind of size we were dealing with here. But if we had trouble from a valuation point of view, it was an old analyst trick to just cut the working capital, and that it didn't make the condition of the company any better, but it did make the discounted free cash flow calculation look better. So, if you hire a consultant or an investment bank, look for tricks like that where they can make the valuation seem better than it is without making the quality of the business seem better. But Enrique, what do you deal with in your businesses?
Well, so we'll maybe do that on another call. I'm just gonna share a hack in the interest of time. Okay.
Yeah.
I'm gonna give you one simple analysis that you should do on every company that you own, every stock. And I was short WorldCom in massive size. Okay. Over $100 million, which back then was, I still a big short, but and WorldCom, for those of you who don't remember, was a telecom roll up by this Mississippi school teacher named Bernie Ebbers. It was one of the biggest telecom companies in the world. It might have been the biggest telecom company in the world. And there was a guy named Jack Grubman at Solomon Brothers, and Jack was the foremost telecom guru, and he had this huge conference, and Jack's word was like he was the Dan Ives of what, but much more serious, because Jack wasn't a clown. And we were short WorldCom because we were hearing all these things about all these shenanigans. And we had one chart. It was net income for WorldCom, which was up and to the right, just every quarter, every just boom, 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 boom. They were just growing net income incredibly. And then CFFO, cash flow from operations. So if you go into any SEC filing, you can pull up the Qs and the Ks, and you can see net income. It's just a number there. You can use adjusted. I don't care. CFFO is on the cash flow statement, and that's how much cash is generated from their actual operations. So the problem with WorldCom was saying that they were making like $10 billion of net income. Well, I forget the number. It was about $1 billion, whatever it was. It was a big number. And they were burning $2 billion of cash, not from investments, not from, interest payments, etc.
It had to be accounts receivable.
So they were screwing with their working capital, and they were doing, to a certain extent, what OpenAI might be doing, Nvidia and Oracle, was they were booking revenue for things that they weren't actually getting cash for. So I will just share working capital. One hack. You should run this on every company. And by the way, when you see companies that are growing net income, and sometimes some companies will have positive working capital cycles, they're growing CFFO greater than net income. That's great. That's even better, but this is one hack anyone can do. All you need to do is you pull up, and you can pull it off. There's plenty of data sources now. Just pull up those two lines, net income and CFFO, calculate the ratio and see how they're growing. And if they're growing linearly, great. If there's a big, this pattern, I'm trying to do this here on inverse, this is net income and this is CFFO, get the hell out. Okay.
Yeah.
So I'll say that's where, as one of the, I had a short book of over $1 billion for probably, close to a decade in my career. I'm one of maybe 30 people on the face of planet Earth that can say that. That was one of my first things I would do anytime I was looking at short, just look at CFFO versus net income. So I'll leave that on a working capital hack that can potentially save you a lot of money.
Sounds good. All right, Enrique, thank you so much for doing this with us. Really appreciate having you as a guest host. I think it's the third or fourth time you've done this. Always great having you. How can people find you?
Enrique Abeyta, which my name's right there on X Twitter, which is what I call it. You can check out Truth and Trends is our free e-letter with Paradigm Press Group, which is where I do most of my publishing. We also have daily.hxresearch.net. We publish it weekly. And then we've got an awesome piece of software that is crushing it for people making a ton of money called Signal Trader Pro that we're actually just rolling out. It's available for people now, but I would check out those three things. So Truth and Trends, daily.hxresearch.net, and just Google Signal Trader Pro. And you can see our awesome trading software. It's a recommendation engine. We're basically pumping out ideas, and 70% hit rates, 30-40% annualized. Did real well in the pullback. Super proud of it.
That's great. All right, terrific. So for everybody else, want to thank Enrique. Also want to thank Rob Farian and the team at Flying V. Rob, wishing you good luck with becoming a father this week. Hope Alex is in good health and that everybody does well. Separately from that, also want to give a lot of credit to DKI's interns, Cash and Crow, Samak Jain, and Gideon Rodham, who do phenomenal work on the 5 things. So much of what you've heard today is based on their research and their work, and want to give those guys a ton of credit. And for everybody watching this, we know your time is valuable. Thank you so much for spending it with us. If you want to give us a like and subscribe, that would be great. But hey, we're not the boss of you. Do whatever you want. We'll look forward to seeing you next week. Thanks.
Thank you.